Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, Greg Hall here. Welcome to another edition of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and their clients. Today's conversation, we recorded it a little while ago, but I couldn't be more excited about bringing it to you. It's all about ETFs, specifically fixed income ETFs, and even more specifically, actively managed fixed income ETFs, which have seen a huge amount of growth over the last couple of years and really don't show any signs of slowing down. Joining me for this conversation were Adam Browne, who leads our ETF sales effort here at PIMCO, as well as Todd Mangis, who's an extraordinary account manager of ours, living out in Minneapolis, covering the Midwest and all around being a good guy. It's a great conversation. I think you'll enjoy it. It did make me reflect as we get prepared to put this out into the world, just what a terrific time it is to be a financial advisor. And I know that sounds a little bit, corny, but, we spent an entire podcast here talking about just one method of delivering investment results to you and your clients. And that's the ETF. You'll hear it sort of sprinkled, throughout the episode, and you'll hear me pipe up on this a little bit thematically, but I just wanted to reinforce it here at the top, which is, there's no one tool that is perfect for every job, and ETFs have, phenomenal benefits, and we know many, if not all of you, are introducing them to your portfolios, as we speak. Mutual funds, especially, some that have been around for a long time, have developed scale. They have the ability to do things that, maybe the more rapidly growing, smaller segment of the market doesn't yet have the ability to do. That's something you've got to factor into your own thinking. SMAs, may have a role in your clients' portfolios depending on tax status and the degree of customization you want. But still, just an excellent time to be in your shoes and to have all of this choice and all of these great tools available to you to deliver on what your clients need. The old saying, when somebody goes into a hardware store looking for a 1/4-inch drill bit, it's not because they want a 1/4-inch drill bit, it's because they want a 1/4-inch hole. And we got to remind ourselves sometimes it's not always just about the tool, it's about the outcome. And we're here to provide you all with the tools that you need to deliver the outcomes that your clients want. So in that spirit, very, very excited to bring to you this conversation on ETFs. If you are interested in what you hear, you want to go a little deeper, as always, you can visit us at PIMCO.com. If you identify yourself as a financial advisor, it'll take you right to Advisor Forum. That's our home for you to get the information that you need as quickly and efficiently and practically as possible. We'll be back with you in September. Promises to be a busy back to school period for all of us as we move through the backstretch of the year. Kicking off, of course, with the Fed meeting, and then I think just staying very busy through the balance of 2025. So hope you're having a restful and recuperative summer and getting ready for some, really good opportunities to make great constructive decisions on behalf of your clients as we head into the fall. I'm lucky today to be joined by our head of ETF sales, a gentleman named Adam Browne, who's with me here in the studio. Hey, Adam, thanks for joining.
Hey, Greg.
And then on the line today, we've got Todd Mangis, who's out in Minnesota. Todd,
happy to be here.
Nice to have you with us. Nice to stretch our tech skills here to have you here on the Zoom and in the feed. I'm excited to have Todd because I was just out seeing advisors with him in his hometown in Minneapolis, and then my wife and I were lucky enough to spend the weekend out there and went to the what's it called? It's the Minneapolis Yacht Club Music Festival.
Yep. We went all 3 days. You and you guys were with us for 2.
Yeah, that's right. We had to head back on the Sunday, so we missed some killer bands. that night, but we had an absolute blast exploring Minneapolis, hearing some amazing music, and my wife came home with a bunch of Yacht Club Festival merch, and we've been showing it all to our friends, all of whom are wondering why we ended up spending a summer weekend in Minneapolis. But I got to tell them, it was amazing. It was great. Don't let the secret get out. I don't want it to be thronged by too many people.
Right. It's the best kept secret in America right now.
Yeah.
Where's up in Minneapolis?
The festival or Minneapolis?
Let's go with both.
Yeah.
How's that?
All right. Well, good plug for the Yacht Club Festival, if nothing else. All right. So the two of you guys are here. We're going to talk about active ETFs. Adam, let me just kick things off with you. Why are we talking about active fixed income ETFs? What are the market dynamics that bring us here today?
Yeah, Greg, I think we're talking about ETFs because they're pretty hard to ignore at this point. And maybe I'll sort of size the ETF market here in the US and globally for you. And then, we can talk about some of the recent growth that we've seen there. But globally, the ETF industry now above 15 trillion. Majority of that sitting here in the US, where we're above $12 trillion in assets. And while this industry is not new, it's 30 plus years old. It continues to grow at a pace that few folks sort of can believe is still sort of sustainable at the sort of broad numbers that we're at today. And then flows, right? So you mentioned last year, a record year for ETF flows, $1.1 trillion with a T come into ETFs last year. And we're on pace to sort of exceed that number again through 2025. Through July of 2025, we're at $660 billion here in the U.S. The thing that I'll mention as it relates to like what is changing around ETFs, I mentioned these were launched across equity indices 30 years ago. People cut up the market into sectors and then have gone into other areas. But the market is really coming towards fixed income, right? So today, fixed income ETFs are just over $2 trillion in assets, so call it 15, 20% of the overall ETF market, but they're taking 40% of flows. And then active, right? So active also sort of a later entrant to the ETF industry, went through $1 trillion late last year. So you call it 10% of the asset base in ETFs today, also taking 40% of the flows. So the market coming right to what PIMCO does well, obviously fixed income, active fixed income, and there seem to be drivers here in place that these will be in place for quite some time.
So that's interesting because I think of, and as we've, done more in this market, and you and I have talked about it around the shop, I think a lot of us had to maybe dispel the notion that ETF is synonymous with passive, right? Because there was, I think what we've concluded. Tell me if I'm wrong here. Is that the ETF phenomenon coincided with a move toward passive in the equity markets, and so we equate them, but actually it was sort of two separate things happening at the same time. And what you're describing now is a buildup of active strategies within the ETF landscape. And to, let's be fair, that's happening in the equity markets as well. Active ETFs within equities have been more popular of late. So it's not just fixed income, but it's very pronounced in fixed income is what I hear you saying.
Certainly outsized in fixed income. And, sort of the point you made earlier around passive being synonymous with ETF, I think that's where the conversation starts when Todd walks into an office and speaks with an advisor and says, hey, PIMCO is in the ETF business, which isn't a new phenomenon either, but we're sort of having these conversations with folks first, in a lot of cases, first time. And so I think the assumption on the other side of the table is, oh, great, PIMCO launched some low-cost passive ETFs tied to fixed income indices, and we have to sort of dispel that myth first before we get into what these are, and that these are run by the PMs that you're already aware of, Dave Hammer in the muni space and Jerome Schneider in the short-term space, and they leverage the same process and capabilities that we have at PIMCO to deliver active solutions in the ETF wrapper.
Todd, is that still the case? Is that an accurate assessment of your typical meeting?
Absolutely. I think it goes beyond just having the conversation of, do you use ETFs in your book of business? The assumption now is that they do. I mean, we've watched this. Adam and I have had the fortune of working together for quite some time. And so we had the front row seat for a while when we saw these advisors move from commission-based products at one of the other funds that we covered, and you had to move towards fee-based, platforms. And the early adopters of these fee-based platforms definitely gravitated towards the ETF side of things. And those are the largest advisors that we work with now. And now it's evolved beyond doing a comparison. You're doing steps analysis, which we do with our clients on a regular basis, but they're looking to upgrade those portfolios to having the conversation around, what do we do that's active? How can we differentiate ourselves? We've already dropped the music reference, so I could throw another one. It's the difference between doing chords and doing a solo, right? Chords are the passive, broad-based exposure, gets you the idea of what the market's doing. But on the other side, when you're doing a solo, it really gets attention and adds nuance. And that's what clients are looking for right now. Every advisor we're talking to is not about what is PIMCO thinking, it's what's the companion ETF to this.
Right. That's okay. So there's a lot to unpack there. So, one is, clearly just a rising general comfort level with ETFs. They've been in the market for a long time. Two is this move to advisory, which any financial advisor listening to us here knows exactly what we're talking about, right? Moving away from brokerage accounts and into more fee-based asset management setups, and that's propelled ETF adoption. I love your, I mean, not just because I love music, but I love your reference to, you've got your song structure, your chord, your model allocation, but then where are you going to source alpha? Where are you going to source differentiation? And I think this is sort of an interesting I want to separate these two things. So let's talk about why the ETF wrapper, independent of what's inside it, passive, active, whatever, what's appealing to the advisor about using ETFs versus mutual funds or other types of product? And maybe Adam, I'll start with you, and then we'll have Todd keep you honest since he has these conversations every day.
Yeah, I think the benefits of ETFs, the wrapper, some people call it technology, are pretty well documented. The fact that there's one share class of an ETF that's available to all investors. It's the intraday pricing and trading ability of ETFs that it doesn't matter every day, but sometimes, at inflection points, being able to know the exact price you're transacting at in a product matters, and can differ from time to time throughout the day. Tax efficiency is the biggest benefit that sort of everyone anchors to today, and the fact that ETFs are far less susceptible to capital gains and the ongoing tax efficiency and 6011, the SEC ruling to sort of reinforce that, which has created this onslaught of new products there. But I do think, and maybe sort of check in with Todd there, but the comment he made around this transition to advisory may not be the catalyst for the benefit of ETF, but I think it shows sort of where the hockey stick growth of ETFs occurred. And it was this migration towards fee for advice on, how to put your kids through college, how to afford a second home, all these other things that advisors are now doing above and beyond managing assets for clients, managing liabilities from every major client that we work with today. Their job's gotten more complex. They've had to simplify the investment process to block trade, to own models across their book, and then obviously sort of tuck in to their taxable accounts, their taxable clients, additional benefits around tax and things like that. And I think that is the portion where, as folks migrated to advisory, they migrated to ETFs. And as Todd mentioned, the first movers there are the massive corner office teams that have 30 people on their team now. They're not just financial advisory practices. They're businesses. They're platforms.
Todd, that ring true to you?
Absolutely. He hit on everything that that I think advisors take for granted. Right? It's transparent. It's easy to transact, but it's the size and scale which has really helped streamline these advisors that are growing exponentially every single year. And so it just makes it a lot easier for them to transact, a lot easier to manage a very complex book that's got hundreds of accounts and hundreds of clients. It's a lot easier to transact. I think that's probably the biggest thing that we're encountering. Also, just the ETF landscape continues to evolve, right? So you can get exposure in just about everywhere, and you can take a more tactical approach to managing your book of business and your model portfolios pretty easily.
Yeah, I mean, what I hear from you guys and what really resonates with me is, if I'm an advisor running an increasing practice and I've got lots of, I may have a client, but I might have 3 trusts for that client. I might have 2, kids accounts, kind of falling underneath that. And I may have, other subsidiary, arrangements. And so the ability to transact intraday, know your price, spread that out across, a multitude of accounts if you're managing kind of similar profiles within those accounts, and just be done, right? You're not waiting until the end of the day when a mutual fund strikes a NAV and you're off by a couple of cents, and then you got to go through the whole exercise again the next day, right? So that simplicity, that's very that's very obvious to me. The other thing that I think is interesting on the tax front, capital gains, not something in the fixed income world that like we spend huge amounts of time talking about relative to equities at least, but meaningful. And I don't want to go too far down a rabbit hole, but I do think that the mechanisms by which ETFs can exchange securities and use baskets, things like that tax efficiency, that's a great kind of incremental pickup. And then in a world where, as we may be facing rate cuts and fixed income investors may see total return as maybe a larger portion of their overall return, it becomes something where, our ears might want to perk up a little bit. Is that a fair characterization?
You bring up a very good point of having different types of accounts, 3 different trust accounts, 2 kids accounts. I ran into this the other day with an advisor who was having a hard time selling out of a ladder, just an SMA, and getting a price transacted because he needed to mail or to wire some cash for an event that was happening with a client. And he made the offhanded comment, "This would have been so much simpler if I had ETF portfolios." And I said, "Well, we should probably talk about that." So, but it goes to the point. That's a very good bullet right there, where if somebody's trying to raise cash for an event, right? Events happen. That you can definitely get a more concise transaction done in a quick manner and take care of that need.
Yeah.
And the output here is time, right? If you have efficiency in everything that you and Todd just went through, you have time to work with more families, to address, due diligence for alternatives and other things that people, advisors are doing with clients today. That is an incredibly productive use of that time.
Yeah, and I think it's these are all great kind of explanatory factors as to why the pickup in ETFs has been as strong as it has. I think we should also, let's acknowledge the incumbency. I mean, the mutual fund is by far still the most popular way of accessing, asset management and fixed income, active asset management and fixed income. And, I think that we all, as we sit around and talk about kind of delivering the best value to our clients, you got to acknowledge, like, one thing is, scale products, like some of our mutual fund products that are significantly larger than our ETFs at this point, they can do things that the smaller products can't do. And I think advisors, should be conscious of that. And mostly what I see is actually, I think advisors are really, careful about, when they value the utility of an ETF versus when they value maybe the established track record, the size, the scale, the amount of process and history that goes behind some of these more established products, and that's absolutely correct. And we love to kind of help them think through those issues. And the second thing is something that Adam brought up, which really is a double-edged sword. We know that investors value transparency, but I think there's a real reason to ask yourself: is daily transparency ultimately good for the underlying investment strategy? And we're really careful about that here. I think our mutual fund products and the industry generally is highly transparent, but not daily transparency. And we are very careful about the process and the thinking that goes behind our security selection, and not at all convinced that all strategies should be exposed to daily transparency. I think you got to have respect for the fact that there are quant platforms out in the market that are extremely efficient at taking data inputs and using them to create or to erode alpha in markets. And so I'll just say that it's some things that maybe on the surface feel like benefits may not actually be benefits, and that's the kind of delicate dance I think we and advisors have to perform when we're deciding between which wrappers we want to use for which purposes.
To go back to your first point around mutual funds and persistent demand, and I think sort of a statistic that would sort of underscore that is 80% of the ETF market is still equity, right? Equity moved first when this whole transition that Todd and I just talked about, or we just talked about, like the viable options for advisors at that time were passive, right? There were some active ETFs during this transition, but they weren't at size, they weren't at scale, they weren't from many of the major players that have entered the market over the last few years. And so I think most advisors truly value active and fixed income, right? The numbers support it. On average, the majority of equity managers underperform the index. On average, the majority of fixed income managers outperform their index. So people have held with their mutual funds through this transition while sort of being hyperactive in transitioning equity assets over to ETFs and passive.
Yeah, well, that's good. Thank you. You've brought us back to, I think, kind of the second part of the question. So the first part was, what's special about the ETF wrapper in the advisor's mind, and now, why active in fixed income? Why is it such a pronounced move towards active? And PIMCO, we talk about this a lot. It's a fervent belief of ours that active strategies in fixed income are structurally more able to outperform their benchmarks than you see in the equity market. And that has a lot to do, with the structure of fixed income markets, right? I mean, the Bloomberg aggregate has 10,500 some, bonds in it. The S&P 500 has 500 stocks. A company issuing debt can issue senior debt, junior debt, high yield. It can be attached to a subsidiary. It can be attached to a holdco. It can mature in 2 years, 5 years, 10 years, 15 years, carry a coupon of X point Y, Y point X, Z point, and so just the complexity of the fixed income markets, we think has always, offered us an advantage and an ability to generate alpha, in those spaces. And you couple that with the fact that a lot of, owners and traders of fixed income assets do so for reasons that, aren't about generating an optimal return. They're about defeasing liabilities over a vast time frame if you're an insurance company, or they're about managing monetary policy or currency support if you're a central bank or a sovereign player. And so that, again, affords us a lot of ability to make security selections, take top-down views that can potentially create alpha over time. And nothing about moving to the ETF wrapper changes that analysis, right?
Sounds like you've spent some time thinking about all that.
Yeah, well, it's sort of endemic to the seat.
Yeah, it's that conversation that we always have of why it matters to be active, right? And it's the old Minnesota saying, right? I know Adam's heard this one. It's just, there's no such thing as bad weather, just bad gear, right? Just to sit, you equip yourself with the right piece of gear.
Man, you're 2 for 2 on the analogies here.
Well, I try.
Yeah, and I think it's important to note that, maintaining that level of activity in the ETF wrapper is part also, I think, of the appeal, and what's driven that growth in the last couple of years. I think I'm remiss that we're 20 odd minutes into this and I haven't brought it up, but you, Adam, and along with Kim Stafford, who's our global head of product, and Tanuj Dora, who has been a key member of standing up the ETF effort within PIMCO over the last several years. You guys just published a piece earlier this summer called 5 Themes Defining Bond ETF Investing Today. One of the points, you make in that paper is that the presence of ETFs in the bond market has actually helped to increase liquidity. And this is, again, this is something that we talk about, a lot at the firm, because there are folks in the market that would have advisors and clients believe that somehow, bond markets are illiquid or that moving to less liquid strategies, you're not giving anything up because bond markets are liquid. And the fact of the matter is that our markets have never been more liquid. We've had previous pods where we've kind of gone into this, and ETFs are not the only reason why that is the case, but they've been a contributor over the last few years, and will probably contribute to it going forward in terms of just more transaction volume, more price discovery, more flow. So that's I think that's a secondary benefit that we're seeing from the prominence of ETFs. Well, let's talk a little bit though about just flow trends in the last year. Where have we seen active fixed income ETFs do the best? Which categories have been the most popular over the last couple of years?
Yeah, I think there's basically 2 that have been sort of really outsized relative to the others. The first being sort of ultra short, right? Which is probably not a huge surprise to certainly you and Todd and anyone out there, but sort of given what was previously an inversion of the yield curve, some really, an extreme aversion to owning duration in most portfolios from clients that we're meeting with. People have been huddled in money markets, huddled in cash. And I guess the first way we've been able to get folks and work with folks on moving out of some of that stuff has been into ultra short type products. So 0 to 1 years in terms of maturities, but you have more flexibility above and beyond T-bills to add additional yield, additional return. And that's been a really good outlook for folks. And there's been also, innovations around AAA CLOs and other things that have led to sort of meaningful growth in that ultra short category. The second, which is sort of more in the sort of year-to-date category than it would be sort of in the trailing 12-month, is just core and core plus bonds, right? And I think if you look at returns in fixed income over the last, or I guess just on a year-to-date basis, that ultra short category is up about 2.5%, right? So you see, Fed funds at 4.5, you're getting 2.5 there. That kind of works out. You're annualizing at 5% or so. It's about double that in core bonds. Core bonds have actually been pretty good on a year-to-date basis, giving you closer to 5%. And so I think people are again, sort of starting to see some steepness return to the yield curve, starting to see bonds trade like bonds on a bad jobs report. That is a positive sign for folks that sort of, we work with folks that know that they're going to have to move into fixed income. And it's a category PIMCO knows incredibly well, having a huge market share in that category across vehicles. But it's effectively a category that didn't exist 2 years ago, right? The category, multi-sector active ETF category, was $3 billion 2 years ago. Today it's 30. And so I think it tells us one thing. One, it's multi-sector, so it's across everything from treasuries to high yield and bank loans. It's flexible, right? Which again, people want because they're still stake bit from 2022. Right. And so I think those are 3 areas that we've seen growth, and they'll probably lead the way for quite some time.
Yeah, that's interesting. So one, what that tells me is it's very logical, right? It's a very rational response to markets, and it's not it's not unlike what we've seen, elsewhere in our business or in the industry broadly. Short term's been popular,
Yep.
right? A lot of advisors very, very happy to capture, cash rates at the front end of the curve while they wait for more clarity on the path of rates and Fed movements going forward.
And it's worked.
And
Yep.
And so I think while we've tended to encourage that they explore taking on some duration and moving out on the curve and getting ready for a world that's more characterized by incremental cuts, we certainly don't blame anyone for being conservative and hanging out in cash, and we'd like to encourage them, to continue to exploring options. But that's been a good place for them to be. Secondly, I think as it relates to I'd say more recent increase in interest in core bonds, that fits with sort of what we've been talking to advisors as well. And then I love your characterization of multi-sector. Because that is, what we often tell, our clients and advisors we speak to is the more flexibility we have across any dimension to use our process, the more alpha we feel like we can potentially generate. And so that innovation of bringing strategies like that to the ETF market is it's not entirely surprising to me that it's been as popular, as it has in recent days.
And there is an education gap there too,
Sure.
right? That is like the antithesis of what you would expect sort of an ETF buyer 10 years ago to look like, right? Someone that said, hey, we're going to own, the S&P, some international, some small cap, and maybe we'll sprinkle in some energy stocks or some international real estate or like some themes like that. But to sort of hand the keys over in an ETF and say, go ahead, tell me where I should be in duration, tell me how much credit I should own, figure out how I should own mortgages, is really different than how a lot of sort of early ETF allocators thought about allocating. And so we've spent a ton of time on just education, leveraging tools and things like that on where this fits in a portfolio and how it rounds out.
I do want to talk a little bit about product development, Adam. We've been, I think, relative to some headlines out there, I think we've been relatively, shall we say, deliberate, intentional,
Yeah.
About how we approach this. We haven't converted a lot of mutual funds to ETFs. We've been, I think, pretty measured in our pace of product development. What's the thinking behind that? What are we sort of aiming for there? Why not a bigger blast?
Yeah, so I guess a couple things. Now there's more U.S. listed ETFs than U.S. listed stocks. So people have been very aggressive in terms of putting product into the market. You mentioned we've been far more deliberate around what we're doing. I think we're trying to intersect two things. One, we listen to our clients, right? We have Todd and our peers across the country sitting in front of clients, asking really interesting questions about how they want to continue to work with PIMCO. And we take that feedback and we listen. And we try to intersect that with what does PIMCO do really well that we can package into this wrapper versus package into an interval fund versus package into an SMA and other things. And so as you mentioned, we've launched 6 products over the last 3 years. We did convert one mutual fund into an ETF. And I think we'll continue to find opportunities where we have client demand, where we have expertise to broaden the ETF lineup. But I don't see a scenario where we're going to have 100 ETFs in any sort of meaningful trip down the road.
Yeah. No, I think selectivity is key, and also, like what you said, I think this the stars aligning between what our advisors and clients need, where we think we can do a great job on their behalf, and where it fits, in the wrapper that we're talking about. I want to be conscious of time here, because I think we could talk about it's such a huge market. It's so dynamic. and and it's become such a topic of intense interest from the advisors that we speak to. So we could probably go on for hours. What do you think? What are you looking at? Around the corner, Adam? Like, what are the developments that you're tracking? What should advisors be looking at and reading about as it relates to ETFs or fixed income, active fixed income ETFs specifically?
Totally. So I think a couple things, right? So I think you're going to continue to see meaningful growth in ETFs and adoption of ETFs. That seems like a trend that's going to continue to play out. I don't think, I think that the continued demand towards fixed income will be buoyed by, number one, yields being attractive where they are today relative to what they've looked like over the last decade. Potential Fed cuts in the future is another sort of catalyst for continued fixed income demand, and then just the product that has come into the active ETF space since, again, sort of the SEC passed the ETF rule 6011.
That was 2019.
Yeah, 5-6 years ago.
Yeah.
Created this onslaught of new product, right? And new active product. And that product is coming of age, right? It's coming of age in terms of track record. It's coming of age in terms of assets and trading volume and tighter spreads. And now those products are more viable than they have ever been. And so I think that'll be a continued adoption of sort of active fixed income. So I think that'll continue. Two, I think you'll see firms continue to push the bounds on the ETF wrapper, right? I think crypto is a great example of that. We don't have a horse in that race, but crypto ETFs were approved at the end of 2023, effectively launched at the beginning of 24, and at the last number I saw was $160 billion that have migrated into ETFs that own crypto, and there's been not just Bitcoin, but other cryptos that are coming into that structure. And not only are they, investors finding this, but advisors are now managing and giving advice on crypto exposures across a broad platform. So I think that's another example of like something 5 years ago we were talking about, not on our radar,
right.
But coming here. The other big sort of thing that I think are two more things is private credit and alternatives and things like that coming into the ETF vehicle. I do think, obviously, there's a huge push right now to get alts in the hands of more investors here in the U.S., which I think is a positive development. I don't know that like truly illiquid real estate and other things should be sitting in a 40 Act vehicle. That, again, like there's benefits to not marking to market some of these strategies and investments, and bringing that into a structure that's going to price intraday and have to settle T+1. We'll sort of see if that plays out. There's been a ton of news. There's been sort of a lot of excitement around this development playing out in ETFs. Assets haven't necessarily followed yet, but I think you'll continue to see development there.
Yeah, it's an interesting. I mean, that one's an interesting dynamic, and I think we should be, we'll be careful in how we describe it, because I do think, or at least my personal view, you had made the comment earlier, about how the ETF wrapper that trades intraday, can help to shine a light and give actually price discovery and price transparency to sections of the market that didn't previously have it. And so there's a world in which you applaud efforts to have a proxy for the value of a private credit portfolio that where market participants can effectively vote on whether they think it should be at a premium or a discount. On the other hand, and maybe this is just like a little bit of cynicism on my part, I think one of the reasons some of those solutions haven't taken off yet is that a lot of what a lot of advisors and a lot of clients, maybe unconsciously, and some quite consciously, value about these private credit products is the smoothing effect of the accounting rules which allow for mark to model. And so if you inject volatility into that equation, you can see it being very unappealing to somebody who valued the lack of movement in the NAV as a feature, not a bug of that investment. And I think that's something that, the industry needs to kind of sort out for itself. But that, you're right, that's a really interesting test case. Crypto has been a very interesting test case, and shares a theme, actually. You mentioned the 2019 ruling by the SEC, but obviously, this year we've seen the Genius Act, and you've seen, a little bit more regulatory clarity around some of these things that's actually fueled, an increase in take up in the marketplace. So that's all fascinating. The other thing, we haven't talked about is of course the potential for ETF share classes of mutual funds. We'll leave that to the side, I think, for this conversation, as that sort of works its way through regulatory channels. But for a global audience, should note, that other countries, Canada, Australia, have really vibrant markets in which investors can simply purchase an ETF that maps to an existing mutual fund as a share class of that mutual fund. And that may be something that we're contending with in the U.S. market at some point in the next 12 months. And that's going to create all sorts of challenges and all sorts of opportunities, right?
Totally. And it's going to take, what we're hearing from clients, partners, platforms is it's going to get passed at some point, but there's a lot to figure out. And sort of the pace of adoption of that share class at some point in the future will take some time for the industry to be able to sort of absorb. So to your point, we'll see how it evolves in the months and quarters ahead.
Todd, anything we're missing from, folks you speak to that we ought to touch on before we sign off here?
Yeah, there was one big glaring miss that I didn't hear, because we talked about flexibility, transaction, ability to have transparency, is munis. With the growth in that, the taxable asset base that our advisors are working with, I'm getting a lot more questions about munis and whether or not they fit within an ETF wrapper. And the answer is yeah, they do. They definitely make sense. It's easier to deploy across an asset allocation, much easier than a single bond or a ladder. And sometimes a ladder just doesn't work. And the big thing about that is just the efficiency that you can gain municipal exposure into a product mix without having to go hunt down bonds that may or may not be mispriced, right? And then probably the last thing is just the fear of missing out. I think there's more and more conversations that we're having with clients. Advisors are coming to us, should I be using ETFs? And it goes back to what you said, Adam, and I think Greg, you even touched on it, was education, right? Yeah. And just have a conversation.
Yeah, I think, thank you for bringing that up, because,
it's good for him to keep us honest, right?
Yeah, it really is. But yeah, because we talked about some of the sectors that, have been most popular. And munis is in its own, munis is kind of the one sector of fixed income really, like year to date over the last 12 months that just hasn't had the same, performance tailwind that some of the sectors we've been talking about have, whether it's multi-sector, short term. And so that should be piquing advisor interest. And then the way that people own munis is it's a little different than the way they might own some other strategies out there. And so there's a different comparison that takes place when they think about ETF versus how they hold it in a ladder, how they hold it in a mutual fund, the tax consequences, all that stuff. So that's a really good point, Todd. Thank you for throwing that into the conversation. And we're probably overdue for a muni conversation with Dave Hammer, our portfolio manager in that area, on the pod. Given some of the opportunities opening up there, so we'll get that on the schedule. But for now, let me just thank you both for joining us.
Thank you, Greg.
Great conversation. Really hope advisors listening to this, investors listening to this, can take a lot away from this conversation. As always, if there's anything you want to follow up on, please do visit us, PIMCO.com. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum. Advisor Forum is our one-stop destination for you as an advisor to get the information that you want from PIMCO in a quick and efficient and practical manner. And everything that we've discussed today, you can find the piece that we published that I referenced that Adam's an author on. You can find any other research pieces that you might want to go a little bit deeper on. Please also reach out to your sales coverage at PIMCO if you've got further questions. We didn't talk about specific strategies on this podcast, but if you wanted to go a little bit deeper, you can, of course, do that on the website. But what I hope is that you as advisors can take this conversation, inject some of the takeaways into your practice, and just have better, more constructive conversations with your clients about what's changing in the landscape and what they ought to be thinking about. Finally, I will say this: please, if you enjoyed listening today, if you enjoyed listening to a previous podcast but didn't like today, either way, if you could hit the subscribe button, let us know you're out there. It really helps us, bring content to you and invest more deeply into this platform. We will see you next time in September. We have an action-packed fall ahead of us, and so really looking forward to what the world will bring and being able to talk to you about it on the podcast. Thanks so much.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures